Good morning. Welcome to the On SEAF Model. I'm Jack Kosar. This is effective for the week of April 7th, 2025. Let's get started. SEAF signals for this week. We have healthcare, utilities, and consumer staples. Having financials drop down the list quite a bit due to relatively strong outflows. Holding on a little bit to this neutral via its strategic quarter of one. Healthcare top signal coming in relatively strong. Two very strong ones with utilities and healthcare rankings of 7, and on the move up, consumer staples with a ranking of 10, and then not a SEAF signal, but rounding out the top 4. Also in favored, we're looking at real estate. Pretty strong conviction at the bottom here with technology 11s across the board and consumer discretionary at 10s across the board being our worst ranked, and a little bit of neutral here with communication services middling a bit somewhat, and like I said, financials dropping down after strong week 2 weeks. Looking at our heat map. Despite the negative things happening in the market due to the recent tariffs imposed on the world, SEAF is aligned more or less where you would expect it to do, and it is strongly aligned. You can see here we are very defensively skewed with consumer staples, healthcare, and utilities all being in the top, and this block of green showing the strength in those sectors. Really aligning itself strongly with those greens on top. Similar things with the bottom. We have red, obviously, outflows being what they were, but technology really strong outflows across the board as the economy seems to be headed in a bearish direction. Also, a couple of key things to note. These 1s and 2s are really, actually 1, 2, and 3 on the trading week, relatively strong. Again, this is our algorithm that we are calculating. These aren't, just raw flows, but we saw a 0.4% inflow via our algorithm into healthcare, 4.6% inflow for utilities, and 0.39% for consumer staples. The main point being is that those are all really strong conviction bets, meaning that those investors that must stay in the market even during rough times are putting their money into what they consider to be safe places, which is healthcare, utilities, and consumer staples, because those tend to be recession-proof. People still get sick when we're in a recession. People still need water and electricity when we're in a recession, and people need their staples during a recession. So really kind of aligning ourselves in that we are not predicting a recession, but those are what managers seem to be flocking to in the fear of a potential future recession. Again, real estate looking not super coming in at 4th. I wanted to note that those flows are relatively light. You can also see that by the lightness of the green here. And again, really strong outflows in technology, 0.77% on the trading week, and just really accumulating a ton of outflow money into technology through our strategic quarter. A couple of key things to note. Asset flows were extremely, in terms of the overall 11 sector spiders, we had a 9.55% decrease in overall asset flows last week, which accounted for about $29 billion. So a lot of money flowing out of the sectors. Again, the money sticking around, positioning itself defensively. Looking now to our rainbow charts, starting off with real estate. Again, I want to remind everybody what this chart represents so there's no confusion. On the top here, we have our daily SEAF ranking. So this is what the ranking is if you were to look at the SEAF model ranking on a daily basis going back 1 calendar year. So these are the scores. This is where we're currently at relative. We are in that low favored ranking. A little bit of a plateau here. As you can see, we had a little bit of a run up when it went from avoid to neutral into favored. Never quite getting in that upper favored for a signal, but we did pick up some relative outperformance. This bottom of this chart is relative outperformance versus SPY. So that means that even in a down market, even if that particular asset class or this particular sector spider is down on the price chart relative to the S&P 500. That's what we have here at the bottom. So you can see here we've had a little bit of relative outperformance versus SPY, also picking up a little bit since the tariffs have been enacted. We will see if we can get those asset flow numbers up, potentially vaulting itself into the top 3. But if we're being, from looking at the numbers, a lot more flows coming into those other top 3 sectors. So we'll, kind of wait and watch here, but seeing a little bit of a nice relative outperformance trend in real estate. Looking at technology, for those investors that are using the SEAF model as a model, but are a little bit spooked right now, so they may have pulled their money last week. Just an way to look at this too is just not only where do you not want to be when you re-engage, but where do you where is it looking the worst? And right now technology is looking the worst. We have 11 in all 3 time periods, totaling a total score of 33, which is as worse as it gets. And as you can see here, that relative performance, we were sitting in that relative performance box for quite a while. We have broken through that, and as of right now, we are seeing underperformance to the broader market, even so, technology definitely an avoid place. We are about as low as we can get, and it's represented in this relative performance chart. As I actually had to adjust the left-hand margin so that I can fit the new relative performance data. Utilities, and again, relative performance here on the bottom. This is not a price chart at the bottom, relative performance chart. Relative performance seeing some strength in utilities. We just broke this recent upward bound resistance level, which now becomes support for this relative performance chart. But overall, looking strong. We've been sitting in this kind of mid-favored now for a bit. We're accelerating up. As I said, utilities had a really strong inflows on the trading week at a 0.46% increase via our algorithm, and came in 2 on the trading week. Seeing some strength in the relative performance in utilities. Similar note for healthcare. Healthcare is upper favored, kind of came back touch neutral, and we're heading up toward that upper favorite again. Strong across the board, trading week of 1, strategic quarter of 2, some sustained flows here. We look to have broken that slight upward resistance here on the relative performance versus SPY for healthcare, and have a little bit of room to run here as long as we continue to see our algorithm produces those strong flows, in terms of relative performance versus SPY. Like I said before, even, we are not predicting a recession, but even during a recession, people get sick. Last but certainly not least, consumer staples rocketing up the board, seeing some nice relative outperformance versus SPY, coming up here on this upward resistance that we established in late August, early September of last year on the relative performance side. But some relatively strong inflows via our algorithm at 0.39%, sitting in that mid-favored, and showing some nice relative outperformance. So if you need to stay invested, we're going to be defensive in nature in terms of our investing, and pick up some relative performance gains versus SPY by staying in these defensive sectors. Otherwise, looking at our map, technology is a place to avoid. Healthcare, utilities, and consumer staples looking relatively strong place to be on a relative basis. That is all I have for this week. I look forward to breaking the SEAF model with you all next week, and thank you.